Welcome to On a Personal Note, Jamaican Television's 13-year-old personal financial program that seeks to educate, elucidate, and motivate. I'm Owen James. This week, in Your Wealth, a senior equity trader gives an overview on the local stock market, some trends in the market, as well as stock picks. The trading week ended November 3 was not a good one for young investors. And in the Achievers, we focus on Part 2 of NCB's Nation Builder Awards, specifically the Innovation Award. On a Personal Note returns after these messages.
On a Personal Note is...
So you're interested in buying stocks? When do you buy? Well, in today's edition of Your Wealth, a senior equity trader gives some useful tips on buying on the Jamaica Stock Exchange. Here's Your Wealth. With the Jamaican economy showing a level of growth and more employed Jamaicans taking home nominally more Jamaican dollars via the increased tax threshold, the average Jamaican may ask, is the stock market a viable option? Today, thanks to microfinancing solutions and Infiniti Capital markets, we have an expert who will give you an overview of the market, some market trends, and his stock picks. Senior equity trader at Grace Kennedy Capital Management Limited, Wade Mars, is that expert, and he gives an overview of the Jamaican stock market. He was addressing an event dubbed Cocktails and Conversations October 27.
Everybody would have heard that the JSE was the best performing market, best performing stock exchange for 2015. That would have been in terms of growth. You're looking on just over 100% growth. There was a large number of takeovers of local firms. Among that list, there was Dolphin Cove, there was significantly DNG, there was Cable and Wireless, right? And of course, now you have the average market PE is at historical highs. PE, or price to earnings ratio, right? Now, the price to earnings ratio, literally what it's saying is that if your earnings are $1 for the entire year, you use a multiple of that dollar to come up with a price. So if you use, for example, a 10 times multiple, then if your earnings for the year is $1, then the price would be $10, right? So what it says now is that that multiple has been increasing, or it has increased over the past 12 to 15 months, literally. So whereas the average PE on the market prior to 2015 was about 8 times, now on the main market it is closer to 13 to 15 times, and on the junior market it is actually closer to 20 times. So what you have is that the average market PE, as I said, is at historic highs. On the contrast, you have BOJ CD rates, that's fixed income rates. Those are at record lows. So the BOJ rate for 30-day CDs, that's 5%, right? The 182 T-bill rate, that's also very low, that's 5.7%. For the 90-day, it would be like 5.4%. So interest rates in the marketplace are low. They've been low they started trending downwards significantly from JDX1, right? And then there was NDX, and they've just been continued going down. So right now there's an acceptance in the market that low interest rates are here to stay. And then you're also looking on inflation rates, which are also low. So you know the real return on fixed income investments, it is real, but it is very, very minuscule. Why do we point this out? Because this is an alternative to investing in the equity market. All right. So that in and of itself helps to drive stock prices upwards. if your alternative investment isn't giving you much, then people are going to switch, and that switch drives up prices. So as interest rates fall, then price earnings ratios are going to continue moving upwards.
So what were the various equity markets like at the end of October?
Our main JC index, which are the more mature, larger companies, that's up 10% year to date. The junior market index, that is up 33%. Now, if you recall, the junior market, those are the smaller cap companies that are more recently listed and that have more aggressive growth. What we're saying now is that if the company is growing more aggressively, then people are going to buy it at higher PEs because they expect to be compensated for that price premium in a shorter period of time. What are we looking at? Interest rates, very low. Inflation, very low. The conditions in the market still remain bullish, right? And when you have a bullish market, what you have is that people price the investment instruments based on where they project the profits to be rather than where the profits are. So if you expect the profits to grow and then you're using that multiple of 15 or 20 times, right? Even though you may the profits may currently be at 50 cents, right? And let's say using a 10 times multiple at 50 cents, then under normal circumstances the price would be $5. But you are looking on future profits that you expect to be 60 cents, and because the market is bullish, they're pricing it on projections. So instead of using the historical of 50 cents, they're using the future profits that's expected of 60 cents, so they're pricing it at $6. And then on top of that, you have a more aggressive multiple. So instead of using a multiple of 10 times, they're using a multiple of 15 times, right? So you end up with a $9 price with a 15 times multiple on the 60 cents. So you see, that's what really is pushing the prices forward.
After all of that, what are Wade Mars's recommendations regarding stocks?
We like sticking to what we call blue chip stocks, right? So we like companies that have a long track record of being in the marketplace, and they also have steady earnings and pay good dividends. All right? Now, you may be wondering if we have all of these things running up so fast, why would we be looking and saying, okay, go into slow and steady rather than fast and furious? The thing about it is that you would be getting in literally on the tail end, what can be the tail end of a bull run. If you're on the tail end of a bull run, it means one or two things are going to happen. The price is going to stagnate for a bit before you get any real sort of returns moving, or the prices can come off. All right? The safest thing to do is literally to, go into some companies that you know will continue to perform steadily. Their prices haven't moved out as aggressively during the time period, and they pay steady dividends. So you're looking on the Scotias, the NCBs, the Carreras, companies like that. All right? There's also participating in upcoming IPOs. Now, there is expected that over the next 6-8 months, we're going to have a lot of IPOs coming in the market. Now, not every IPO that comes out will be worth buying, but once a prospectus comes out, you speak to your broker, you talk to Dino, right? And he'll be able to tell you, yes, this one is one that you can participate in. No, this one is not one that you should participate in. When you participate in an IPO, what it means that you get in very early, right? Before everybody else starts buying it on the market. You get in at a fixed price, and you can benefit from the growth in the company going forward, right? And you would get in on a level playing field. If you wait until after the IPO, what usually happens after the IPO is that there is an initial spike, and then they can kind of level off for a bit before there's any growth. When you get in at the IPO level, you get in before that initial spike. So if you want to take advantage of just that initial spike, you can take advantage of the initial spike. But if you're a long-term type investor, you can take advantage of the long-term growth after that initial spike. All right? And we look for companies that earn USD, US dollars as well as just Jamaican dollars.
Smart advice there from one licensed to give such advice. That's Your Wealth. I'm Owen James. We young investors had